So when it comes to buying a house, it's the process is the same with every lender. Now the steps in the process might be different, but we're gonna cover each step regardless. So what does that exactly mean? Well, where all of us are going to check your income. All of us are going to check your assets. All of us are going to check your credit. Because ultimately, home buying comes down to, well, what's your ability to repay debts and what's your capacity to repay this debt. So for a living, what do you do full time?
I'm a consultant, like transaction and consulting
Okay. Are you salaried, W 2? How are you paid?
to, yeah, W-2 salary, work for a big firm.
Okay. Well,
I have, I just hit a year here.
we do like to see a 2-year work history. Lenders, anytime you apply for a loan, every loan application is going to ask you for your 2-year work history. And that 2-year work history, often it's misconstrued as 2 years working for the same employer or 1 year working for the same employer. But as long as you've received 30 days worth of pay stubs and you have a 2-year history in the same line of work, then you're good to go. So the fact that you've been working at your job for a year, it's great. Now we just need to find out, where were you working before then, and is it the same line of work? If it is, wonderful. If it's not, well, often clients will say, well, Paul, I was in college the previous year. Well, great. And you're going to school. That is part of your profession. The last year of college would count as 1 year towards your work history, plus the 1 year of work history. That would count for 2 years of work history. In your case, I imagine you worked at a different company. Is that correct?
Yeah, different company, but yeah, similar enough.
Okay.
Why?
And how much is your annual income salary? Okay. And are you applying for this loan by yourself, or are you going to have others apply with it, on it with you?
I think I'm going to price it, or at least understand what I call for by myself.
Okay. And so, qualifying for a mortgage, it's not as hard as one might think. You take your annual income, you divide it by 12 to get your monthly income. At $190,000 a year, you make about $15,817 a month, let's call it. So now, once we have your monthly income, we being your mortgage lenders, 15,800, just for simple math, we don't want your monthly debts, liabilities exceeding 50% of that amount. So we take 15,800, we divide it in two, and then you get, what's that, 7,900. So we want to make sure that your payments all in don't go above 7,900. Now, what are the payments that we're talking about here? Well, the payments that we're talking about here are your mortgage, the new house that you're going to have. So your principal, your interest, your taxes, your insurance, any homeowners association dues that you might have that come along with the house you're buying. Other debts we're talking about are things like your car payment, your minimum credit card payments, student loan debts, department store cards. Things we're not talking about are things like health insurance, your living expenses, your utility bills. Those don't account. That's what gets taken into the other 50%. So when we have 15,800 as your monthly income, we divide that in half. That gives us $7,900. And now we can't have your debts exceed that. So tell me, how much is your monthly car payment?
No other monthly debts.
Perfect.
Oh, car, college paid off.
Awesome. You're in a great spot. So as far as your mortgage payment now goes, if you have a no debt, you don't want your new mortgage payment to equal half of your income. Now, someone like yourself wouldn't want that anyway. There's a reason why you have no debt, and that's because you make smart decisions. With that, you wouldn't want your payment to exceed truly more than 40% of your monthly income for loan qualifying purposes. Now, how much house are you looking to buy? I imagine it's much less than what you actually qualify for. It usually is.
Yeah. That's kind of what I'm trying to triangulate. I think most of the houses that I've liked are, call it 600 to 650 in that range.
Okay.
But yeah, trying to understand what that actually comes out to on a monthly. It is what I'm hoping to get a better stuff.
Perfect. Well, let's do that now. So obviously, well, first step when buying a house after deciding you want to buy a house is deciding, hey, what's my monthly budget? If you're looking at $600,000 to $650,000 houses, depending on down payment, depending on property taxes, homeowners insurance, HOA payments, your payment could be anywhere from zero point 0.7 to 0.9% of the purchase price is typically what I find here in Houston and surrounding areas. So how much money are you wanting to put down on this $650,000 house call?
Yeah, I'm hoping to not put or hoping to not put down 20%. Um, so that in my mind, something more like as low as 5% or maybe as high as 10%.
Okay. Well, common myth still to this day is homeowners still think they have to put down 20% to get a loan. The reality is that's not the case. As a first-time homebuyer, you have the ability of putting down as little as 3% down, and then you can put down as much as you want on top of that if you like. The downside between putting down 3% versus 5% or versus 10% isn't so much to do with your interest rate as it is with your monthly mortgage insurance. Interest rates historically would lower the more money you put down. Well, recently, the interest rate we found stays the same, especially with those that have higher credit scores, which I imagine you do. So the biggest difference we see in down payments is monthly mortgage insurance. So you can't put down as little as 3%. We'll show you options, of course, saying, hey, here are three options with 3%. Here are three options with 5%, and here are three options with 10%. You, of course, will make the decision that's best for you. I'm sorry. Your payment at $650,000, taxes, insurance, all in, I'd say you're going to be somewhere between $5,200 and $6,000. So if you have the address, we can look up the property taxes, see exactly what those come out to annually, and then get a closer number. For the most part in Texas, I typically factor a 2% tax rate. Why? Well, because there's a homestead exemption, and your homestead exemption in Texas equals 20%. So average tax rate around 2.5%. Of course, that's not the case everywhere, but as an average 2.5%, give it the 20% homestead exemption. That takes you down to 2%. I usually do 2% now of the purchase price, which would be $650,000. That gives you $13,000. We divide that number by 12. That comes out to about $1,083 a month. And then that would be your monthly tax liability. If you put down 3%, you do have to escrow your monthly payments. If you put down 5% or more with your credit score, which I'm imagining is close to 800, you can waive your escrow requirements. Most lenders want you to escrow unless you put down 20%. With good credit, you can put down as little as 5 with us and not have to pay your escrow.
Okay, gotcha. So most lenders look for an escrow for under 20% down payment, but that can be waived with.
Correct. If you call traditional banks aren't going to have as many loan products as local independent companies like ours do. So banks much larger of a company than we are, of course. But when it comes to loan products, independent companies, that's another term for brokers, will always have more loan products than banks. And because of that, we have access to those products. Well, you can put down 5% and not have escrow requirements, to where with the bank, you have to put down 20% to waive it. Same with credit unions and online lenders.
Oh shit. Okay. No, good to know. Yeah. Let me see. Let me look it back up. I want to say I'm sorry, around 760 for credit score.
Okay, perfect. The way credit score goes is 780 and above puts you into tier one interest rates with all mortgage lenders. 760 to 779 puts you in tier two with mortgage lenders. And then it goes down in increments of 20 all the way down to a 620 credit score. So you putting down 3% on a $650,000 house gets you an interest rate, and this interest rate is with zero loan costs. So that is zero processing fees, zero underwriting fees, zero origination fees, zero servicing fees. These are zero lender fees. And what you would get with zero lender fees is a 6.125% in this for this house. A 6.125% would give you a principal and interest payment of $3,831. So that's $3,831. Then you would have a monthly mortgage insurance, so PMI, of $163 for a total monthly payment of $3,994. That's without taxes, without insurance. So now if we take taxes and the insurance, we said taxes was going to be about $1,100, right? We add that on to the almost $4,000. Now we're at $5,100. And then we go out and get insurance. And let's say insurance is anywhere from $3,000 to $5,000, just to give a wide array. That's going to be anywhere from an additional $250 to $400 a month. So we add that on top of the $5,100, and that's how I arrived between $5,200 and $6,000. So it looks like you're gonna be around $5,500 with 3% down. Now I want you to imagine in a childhood playground a seesaw, and on one side of that seesaw we have rates, on the other side of that seesaw we have costs, and as one side goes down, the other goes up. So it all comes down to balancing the seesaw out with what's right for you. So what I just gave you was a seesaw middle of the road. Here's the rate and here are no closing costs. So you might say, well, Paul, let me see what are my lower rates. Well, lower rates mean what? Higher costs. So let's explore that. So at the 6.15 zero loan cost, we had a principal, interest, and mortgage insurance payment of $39.94. If you were to increase those costs by $6,000. So instead of spending zero, we're even, you're going to spend $6,000. That means you're going to bump up your closing costs, which is going to bump down your interest rate. The interest rate is going to go to a 5.625, so 0.5% lower. And your payment with taxes, insurance, and monthly mortgage insurance is going to be $37.92. So now the question begs, well, if I'm spending $6,000 today at closing to get a lower interest rate, so I'm going to spend $6,000 to go from a 6.125 to a 5.625. So the question is, if I'm spending $6,000 to do that, how much money am I going to save every month? And then how many months is it going to take me to recoup those savings? So the difference there is it's about $200. It's $201. So $201 into $6,000 is what? 30. 30 now, 30 months calculates into 2.5 years. So if you're going to live in this house for at least 2.5 years, or keep your loan in place for at least 2.5 years, then this is a great deal. And what I mean by if you plan on keeping the house for more than 2.5 years, that's 30 months times $200 equals the $6,000 that you spent, right? Now, every month after that, you're saving $200. So basically, you're prepaying interest in advance. I'm going to prepay $6,000 in interest today to save over the life of the loan $200. So again, if you keep it more than 30 months, you're good. Now, often home buyers will make this mistake. Well, I'm going to keep this house for 5-7 years. So of course I'm going to do this because I have it more than the 2.5 years. Well, what happens if interest rates drop in 12 months and then you refinance? Well, now you haven't kept the loan for the full 30 months. So in theory, you haven't recaptured the savings, right? You only had it for 12 months. So 12 months times $200, the amount of money you were saving every month is $2,400, but you spent $6,000. So now you're short $3,600. That would be the downfall. Now, with that being said, at that point, you'd be refinancing into a better loan. So over time, it would become a better loan. Make sense? The other thing to consider in buying down your interest rate or prepaying interest in advance is not only is the $200 a month savings, but at the end of that 2.5 year period, once you caught up to your savings, you're actually going to owe less money on the 5.625 rate loan than you would the 6.125 rate loan. Because obviously when your interest rate's lower, more money goes towards principal, less money towards interest. So not only when you're considering buying down your interest rate, do you want to consider how many months is it going to take me to recoup those costs, but also what's my principal reduction going to be over the time of that loan? homeowner's insurance 0.3 to 0.8% of the purchase price. So the higher the amount, I go lower to the percentage. So if you're buying a house at 650,000, 0.7% of 650,000 is what, about 4,500 bucks. I would estimate your insurance to be somewhere around the $4,500 range. Now that could, if it came out to $3,200, would I be surprised? No, I wouldn't. The cost of insurance has really fluctuated as of late. And it not only comes down to the dollar amount of coverage, but also what type of coverage that you want. And you can reach out to the same insurance agency that has your car insurance. I'm sure your realtor has an introduction. We work with local insurance agents that we'd be happy to introduce you to. So your cost for that, I would estimate around $4,000. And then if you're plus minus 500 or so, you're in a good place. So altogether, I was estimating your taxes and insurance to be anywhere from $1,300 to $1,500 a month, in addition to your monthly mortgage payment.
And then up under the different down payment, sorry, under the different 3, 5, 10%, what did you come to again for, I guess, the mortgage interest? I guess tax and insurance won't change. It's some down, yeah.
Yeah, that'll stay the same each month. The PMI is the big one. Yeah, it was a 6.125, no lender cost. In this case, putting down 5%, a 6.125 would cost you $1,400. So what you're seeing here is you're putting more money down, and to get the same rate, it's costing you more money in the sense of fees. So to get the interest rate with the same cost for the no cost loan option, you have to bump up your interest rate to a 6.375. And the reason for that is the higher your rate, the less your cost. Remember when we talked about the seesaw? When interest rates go up, cost goes down. Well, I'm sorry, when interest rate goes down, cost goes up. Well, in this case, a 6.125 is costing you $1,400, putting down 5%, to when you're putting down 3%, the 6.125 was costing you $0. Now, to keep your cost at $0, you can increase your interest rate to a 6.375. I wouldn't recommend doing that, because for $1,400, which is the difference from a 6.375 to a 6.125, you can have a 0.25% lower interest rate. And that equates out to $100 a month with the example that you're looking at here. So within 1 year and 2 months, you've recouped your funds. Now, if you wanted to buy down the interest rate, if you remember, with the 3% down, the 5.625 was costing you $6,000. Where the 5.625 now is costing you about $9,000. So what's the benefit? And you putting down less money? Well, looks like you're getting a better interest rate. So what's the downside to putting down less money? Your mortgage insurance is higher. So this is rare. This doesn't happen often. I bet if we were to price this out tomorrow morning, it would tell a different tale. But right now, that's where you are. So let me answer a better question, which is the difference in the mortgage insurance. The difference in the mortgage insurance came out to about $65. You were paying, I think I said $163 for monthly mortgage insurance, putting down 3%. Now you're paying $98 for mortgage insurance, putting down 5%. For giggles, let's go to 10% down. So for a 6.125, putting down 10%, it actually costs you $1,600. So 3% down, a 6.125, $0. 5% down for a 6.125, $1,400. 10% down for a 6.125, $1,600. The monthly mortgage insurance at 3% down was $163. The monthly mortgage insurance at 5% down was $98. And the monthly mortgage insurance with 10% down is $73. So we're seeing the interest rates move higher at this 6.125, the more money you put down, not by much, but you are seeing them move a bit, right? Where we're seeing a bigger interest is at the 5.625 and buying down your interest rate. Now let's see the seesaw a little further. If you wanted to buy it down to a 5.625, with 10% down, your lender cost would be about $10,000. Now, if you wanted to buy it down more, so we want the seesaw to go down even more than where it is, then to get a 5.25% as an example, you're going to pay $24,000. So all the times clients call and ask, what's the lowest interest rate I can get? Well, I could get you 5.25%. But do you want to spend $25,000 to get it? And the answer should be no, because it just doesn't make sense to do so. So the better question is, at what point, what rate can you offer me at no cost? And then what are my options to buy down my interest rate? And can you give me those three options for me to look at? Help me along the way, and then let me make an educated decision. So a few takeaways here with you. One is you qualify for the loan. You have great credit, you have great income, and whether you want to put down 5% or whether you want to put down 10%, you have enough money to put down. So the takeaway here is you qualify. Your interest rates, walk away with knowing your interest rates are going to be in the mid 5s to low 6s, depending on the day of the week and depending on what's going on. And whether it's you want to buy in a month, or whether it's you want to buy in 6 months, or whenever the time's right, we'll just look back right here, do the same thing that we did with these interest rates, give them back to you. You'll pick the one that's best, and then you move forward. It's a lender cost. So it's in your loan, a processor is going to be paid. An underwriter is going to be paid. A loan officer is going to be paid. Whether it's called a processing fee to you, an underwriting fee to you, or an origination fee to you, at the end of the day, it's a lender fee. So what I always urge home buyers to do is, hey, what are your total lender fees, including underwriting, processing, origination, admin, marketing, any creative fee that you'll come up with? Instead of you giving it to me on some line item fee sheet that I've got to go through, can you tell me what that number is and then still send me the fee sheet so I can see it on there? But I don't want to have to make heads or tails from 4 or 5 different lenders' fee sheets and try to make up who's charging what. Because lenders will get tricky. You'll ask them, what are your loan fees? And they'll tell you 0. What is 0 mean? Well, 0 meant no origination fees. The underwriting fee, that's not our fee, so we don't want to do that. 5. So getting pre-approved is actually much easier than you think. You've actually already been pre-approved. So you can get your pre-approval letter anytime, any place, from any device, just by going to blinklending.com. And right when you go to our homepage, it's going to say, homeowners, I want to get pre-approved. Click there. Takes you 60 seconds, no credit checks, no document checks, and then check over to your email, no lengthy applications. You have your pre-approval letter sent to you instantly. So you can get that anytime, anywhere, any device, and it's awesome to get each time you're putting in an offer on a specific property. Because imagine this, there's a seller and they get 2 offers. One offer says pre-approval letter dated a month ago, property address to be determined. Another pre-approval letter says, I'm pre-approved today for this specific house. Which letter are you going to move forward with? So that gives you the ability to even put your offer in stronger. And I do recommend getting them daily. When you put in the offer, daily is when you're putting in offers, right? You don't need to get them every day unless you're putting in an offer. And then when you do put in an offer, I'm going to see the address that you put the offer in on. I'm going to look up the address online, and I'm going to call the seller's realtor. And I'm going to say, hey, I'm working with Evan. He's extremely qualified, great credit, great income, great down payment. We actually chatted last year before Thanksgiving. He's been thinking about buying a house now for a few months. Got all of his documents, gone over his options. He's good to go. Your seller will have no issues whatsoever should they choose him. All right, well, hopefully that was helpful. Do stay tuned to like and subscribe if you haven't already for more calls like this. And whether you're someone buying a home to live in, an investment property, a vacation home, first-time home buyer, repeat home buyer, if you have questions, please think Blink. We'd love to get you answers. And from now until next time, cheers.